Gold has marked 50 record highs this year alone, with silver following a similar, relentless upward trajectory. This isn't a standard market fluctuation. It's a period of positive momentum metal traders haven't witnessed in modern history. Legacy media narratives typically attribute these price increases to standard inflation or retail speculation. However, the scale and velocity of these movements suggest a cause that deviates from these traditional explanations. Professional metal traders are observing an acceleration in central bank reserve shifts, alongside a transformation in how silver is valued for industrial use. These movements indicate a growing preference for tangible assets over digital promises. When analyzed together, this surge serves as an alarm bell for a systemic transition, signaling a move away from the current paper-based financial system. The timing of this surge is precise. Gold reached its historic highs exactly as the US dollar suffered its largest 6-month decline in 50 years. This decline highlights the reality of fiat currency. It possesses no intrinsic value beyond the paper it is printed on, functioning only as long as there is collective agreement and psychological belief in its worth. As the circulating supply of these units expands, each existing unit undergoes a mathematically certain devaluation. The purchasing power doesn't just fluctuate, it evaporates. Money operates on trust. The aggressive accumulation of physical metals by central banks suggests the trust required to sustain the current system is under significant pressure. Institutional markets have historically managed the prices of gold and silver through rehypothecation, the creation of digital financial claims that far outnumber the physical metal in existence. This structure functions like a dealership, selling the identical vehicle to 100 separate buyers, while promising to keep the keys in a custodial vault. It's a layer of digital claims mapped to a single physical ounce. The mechanism functions until a buyer demands physical delivery. Once that metal leaves the vault, subsequent claimants discover the underlying asset is missing, exposing the structural failure of the paper market. This paper leverage structure is now facing failure as central banks and industrial manufacturers aggressively stockpile physical supply, exhausting the available inventory. Global financial dynamics shifted in 2022, following the freeze and seizure of foreign sovereign reserves by the United States. That weaponization of neutral financial assets altered the perception of U.S. Treasury instruments. Sovereign nations realized their debt holdings could be frozen at any moment by a foreign power. As a result, foreign nations began demanding a higher yield premium to hold U.S. debt, complicating the financing of a $38 trillion sovereign burden. We are now witnessing a global bank run. Nations are bypassing paper promises and demanding the physical delivery of gold and silver to their own vaults. Using the dollar as a geopolitical tool removed the foundational trust necessary to maintain the global fiat system. China and the BRICS nations are currently constructing an independent monetary infrastructure. This system is designed to bypass the dollar-centric architecture entirely. This parallel system is explicitly anchored by physical gold. Central tracking indicates massive accumulation, including single-month transactions of nearly $1 billion in gold moving between sovereign states. Historical currency resets typically follow a 3-stage sequence: the confinement of domestic wealth, the rapid expansion of debt, and a final devaluation. During this final stage, inflation can transition into hyperinflation. For those holding wealth exclusively in fiat assets, the result is often the complete loss of purchasing power. These structural failures result in severe wealth destruction for the unprepared, while shifting generational wealth toward those holding tangible assets. The global economy is entering a commodity supercycle, a structural transition where trust is placed in physical commodities rather than institutional credit. Physical gold and silver carry zero counterparty risk. They cannot be expanded by a central bank, nor can they be frozen or deleted through digital intervention. Historically, every currency reset requires a return to these tangible assets to stabilize a system that has been destabilized by debt. This record-breaking surge represents the assembly of a physical foundation for the global economy, signaling that a systemic monetary transition is already underway.